Hi everyone, this is Sunday, the 29th of October 2017. Uh, we've been through a week that has seen one big event around the public sector banks that is being much discussed and spoken about. So I'm going to spend some time on that, but let me just update you all that on Facebook. Tomorrow I'm going to be doing an event for Sher Khan, which is going to be a live video event where we'll be essentially discussing the mindset for trading. So if you have any questions, you can probably post it there. We've probably not done this. We've never done this before, so it's the first time we'll be using that format. I'm not sure whether it requires a pre-event. If there's any way of you to actually join the event pre-event, to get a notification. But essentially, what I read about Facebook videos is that it notifies all followers of the page when the event runs live, but at the same time, if you just go there and see there's a post, you can put out questions out there so that we can have anything in advance that you want to discuss. So that's just my event update. Among other global events, I think the big one was Catalonia. If you have not really been watching it, I think as Europe's events have developed over time, everyone from Brexit to whatever happened in Greece has been discounted by the market. So this one, when you're actually getting a state talking about asking for independence, and this is a state which contributes almost 20% of tax revenue to Spain, it's really not making headline news anymore, unlike what would have happened maybe previously. If somebody spoke of a breakup in Europe, it would have brought questions around the euro or the eurozone, and created a much more risk off environment. So this time round, the amazing part is, because of such a long period of these events being pushed down the line, in fact Brexit, despite the vote, is still being discussed, that this event is not really making headlines, even though independence has already been declared, and it's now a discussion as to how things move forward from here. Will Spain be able to get the state back by force, or will they go through talks in terms of how they're going to manage this separation? So these are interesting themes that are going on, and there's already news of at least one or two more such referendums happening. One maybe in Rome was likely over this weekend, and so those would also continue in the background. And I guess till they take serious shape, probably you won't see them in headline news, but that's what is happening in Europe. So people are finally, stepping out and asking for what they want, because till the public at large seriously asks for what they want, they don't really get it in even modern democracy. That's the reality of it. It's true anywhere, including in India. If you think you want, a certain type of infrastructure, lifestyle, cleanliness, you have to take things into your own hands, and that's just about it. So what did we see this week? We saw a major step by the government in terms of reforming the public sector banks, and that had a big boosting effect to the stocks themselves. And what a lot of people are expecting is that this is a turnaround in the sector. And while I'm still to see a finalized published report as to how that is the case, and how it would play out in terms of earnings and equity dilutions over, say, a 3-year time horizon, once you get that kind of a detailed report, then probably you can make a better judgment of what is really going on. But right now, I think a lot of it is speculation. Some houses did think of putting out buy reports, and a lot of it has at least been justified on television as to why you'd look positively at this sector from here on. But what has happened so far is essentially there's a commitment towards less than 20% of the total NPAs being provided for by the government, and that too over a period of time. So the initial provisions would be much smaller than we are thinking, and then the banks would have to actually go out and raise capital from the market itself. And that results in essentially what I was saying over the last 2 years, that these banks have to go through recapitalization, and their equity would bloat, which would in a sense bring down their valuation. So the way the market is viewing it is that this is positive for their valuations, but what you're not pricing in, and what I would really want to see in a report, is how much equity expansion is going to happen. If you're at say if your equity is say 2000 crores, is it going to go to 8000 crores? And then are you going to look at what earnings they will have and what value you will give those earnings on the expanded capital base, and thus is it fairly priced at the current level? So I think that thought is missing as far as anyone arguing that there's a fundamental change. There's definitely a sentimental change, which can limit the extreme downside that could have happened if this was led to pass, if the banks were forced to raise capital on their own without any government support. So that provides some kind of a floor. But on the other hand, because you are getting equity dilutions, the question in my head is, how much upside are you going to price in if without really knowing how much dilution is really coming in? So I think that's just the fundamental side of the argument. Let me see, let some more reports really come out on where people say that all these PSU banks are a buy. Let people put their neck out, and then we'll take a look at it. But in terms of the charts, and because that's the second angle and one that people like me explore, you've gone right back in terms of the index or in terms of the individual stocks, essentially to the trend line resistances, which means all of the public sector banks peaked in the year 2011, and then since then I think I've been giving downside targets over and over again. Most of the short term ones get met. The longer term one is to see a much steeper cut, and even if that doesn't come, most of the near term structures have come, and after this bounce you ended up at the upper end of the range. So you draw a trend line right from the high of 2011 to the high of 2015, and that's where the PSU Bank Index is. That's where a lot of these stocks like SBI are, and so you really are attempting a breakout, but you've really not done it. So to really say that this is a breakout and that everything has changed, I think it's a bit early. Even if prices do go above that line temporarily, I would really look for a consolidation at higher levels to say that this is a valid continuation pattern. And second is that if you consider this to be an impulsive first wave, then you'd look for a wave 2 decline and see that you get a higher top, higher bottom formation start to develop longer term before you really take a call as to a complete turnaround. So why look for so much certainty? Why doesn't it? And I've already explained why it cannot be the case that things have changed. You've seen so many announcements of small amounts, 10,000, 20,000 crores from time to time over the last 2 years. Each of them led to a spike and then a sell-off again, simply because the size of the NPAs could be much bigger than what has already been announced. I mean, just go back till a couple of years back, people didn't even want to believe that there was a debt problem in India. So it was like, I was writing economic articles based on cycle analysis that said that this would happen. I even published a chart from BCA research which was showing the NPA cycle turning up across emerging markets and especially in Asia. And this was like 2 years ago. And by that time, we had still not published our own had still not actually recognized a lot of the NPAs. Still, RBI came out and actually forced most of these banks to actually do so. And even after that, I think that's when a lot of numbers came out where people started publishing, could it be 700,000 crores? Will it be, what will be the total size of the losses? And estimates went all the way up to 10 to 15% of the assets that could end up being classified there. So we've really not classified everything. There are still classifications pending, which is why you get these surprise classifications, but the classification process has been halted because the amount that has already been announced almost wiping out a lot of the equity for some of these banks, which is why recap is needed first, and then you're going to need more write downs going ahead. So that's the other angle which is not being considered, and all of this also requires that the economic cycle, the business cycle itself turns up so that the downside effects are not seen in terms of increasing NPAs in the future. So we are presuming that the business cycle will turn up, and these presumptions are being made by people who've been presuming it for the last 3 years and nothing has really happened. So do we take that seriously or with a pinch of salt in a year where you've already hit 90% of your fiscal deficit targets in the first half of the year itself, not leaving much room for expanding on the upside? So that makes it really difficult, even though you may take the current equity infusions below the line, which is fine. What you need for an economic cycle turnaround is actual spending which would come above the line, and I'm not saying they aren't doing things in that direction. There are a lot of positive things. It's not that GST or demonetization don't have their positive sides apart from the negative, like the government is saying. That if you just go back to the previous business cycle, there were a lot of positive measures if you just kept hearing them between 1999 and 2002. But the business cycle has its own course, and the economic measures which are long-term positive essentially play out when the cycle turns up. So all the upside that you get from all these reforms will be there in the future. When the cycle turns, it will provide the multiplier effect on the upside. But the real big question is, has the business cycle turned? And I think jumping on 1 month numbers of IIP going up and down has not really paid off in the last 2 years. So I'm not sure whether this 1 month's jump last month that you've seen in some numbers is enough to really take a call as to a complete turnaround. So that's how people are reacting. Every time you get one number, one data point, one news event, everyone reacts to a turnaround. Without really understanding that a business cycle is a long-term process. You plot multi-year data points, do a rate of change, and then look at it. And then if you say the rate of change is turning from down to up, then you have sufficient data points to call for a change in trend. And so we've probably not reached that turnaround point. There's definitely hope, but you need to keep watching. So that's where the whole NPS story is. And since you have going to have only a small portion of the asset recapitalization done now based on the measures taken, also over the next 2 years, there's a lot more left coming. And how it will be provided for and actually executed for the rest of it as well needs to be seen. So in that sense, it leaves a lot of uncertainty on the table, as much as it at least brings in the certainty that the government is willing to support its own banking sector. I think that's the sentimental change that it has made. But the action itself has to continue longer. In fact, there was an interesting interview on Bloomberg Quint by an ex-deputy governor saying something similar. He was talking about 7 trillion rupees worth of more, provisions that have to be covered for, which is really a big amount. I mean, most of us don't think in trillions, we think in crores. If he said lakh crores, then I think it would have immediately sounded like a number that we all understand. But that's the number he was throwing up, and I tried back calculating, and it's much bigger than even our earlier estimates. That said, go back to any reform process, it's never a one-way street. I mean, I was just in all this discussion that people were having on what the government has already said. I was just reminded the same government we are moving towards the oil marketing reform, I think way back in 99 to 2000, and they were pushing for it back then. Arun Shourie again and again was bringing up the issue. They would clear it up, and all the OMC stocks actually took off in 2001, 2002. And the discussion was that, yeah, this is the reason that the economy is going to turn around. These are the reforms that are the primary case. And when I go back, in my first 6 months of being at Sher Khan, I took a call that by 2001 September, the stock market would have bottomed out in terms of the business cycle itself, and you would start a long-term 10-year kind of bull market. So I was looking for more of a broad-based economy-wide improvement happening. And so when the discussion came to the OMCs being the key reason for the turnaround, I thought that that is just one reform, and it had so many political issues and angles within it in terms of raising petrol prices and the impact that it has directly on your fiscal and the sentiment that they need to manage, and also that these are public enterprises and there's always opposition to decontrol or deregulation of anything that's public sector. So the announcements definitely drove up the stock prices, but then when you look at it over a 3, 4, 5 year time horizon, those stock prices hit so many upward and downward circuits every time those reforms were off the table, on the table, off the table, on the table, that it's taken almost a decade before you actually got some level of free pricing and an actual sell-off in crude prices that actually helped the OMCs do well after 2013, and I've actually covered them in my value wave investments since then. So nothing happens in a shot. People are expecting that this one announcement is the complete turnaround for a sector that has been languishing and amid so much negative trade. In fact, there was in fact a post on Twitter today itself saying that how is everyone positive here if everyone was just negative? So how is it a sell on news? There have been so many such items that have become sell-on news. For example, ACC, when it was taken over in the year 1999, the day it made the announcement of the takeover and an open offer was to be made, that's the day it made its highest price point in the year 99, late 1999. I think it was around November of 99, if I'm not wrong, and that was around 330 rupees. It made that high near the price that the offer would be made, and from the next day it was downhill for the next 1 year. That said, it was still a long-term bottoming process, but the price high itself was for the time period was made. So that's how things tend to happen when you have extreme news. Similar to demonetization news announced 1 month later, markets bottomed out. So there's always a buy and sell on news extreme that is reached, and it doesn't really tell us anything about the immediate trend. It may have implications longer term. So if you're bullish longer term, sure, it might mean that something is changing, but you surely have time to think about it. The immediate reactions had a lot to do with, at least this is what the market reports say, market here say, discussions say, that there were a lot of shorts. There are a lot of funds that were playing the long short in private banking to public sector banking. I've often played the sell side of that in the PMS that we are in. But if you have a trail, I think my trails, all of them on the averages were hit just a day before the announcement, because prices closed above the trailing stops and we closed out most of them. And so when the big move up occurred, that didn't hurt so much, but I think a lot of funds would still, who have a different strategy, were left wherever they were left open. I think that led to a lot of short covering, and at the same time, longs were being unwound at the private banks, and a day before the event itself, the private banks too started giving, and the NBFCs, their daily momentum had actually rolled over to the sell side. So if you just followed the indicators that you use and the trend that you read into, we did manage to sell a couple of those a day before the event, so that balancing tended to happen. So if you cut a lot of the PSU shorts, added some private sector, the net effect with all those big moves was near zero, which is, or maybe a minor loss, which is what you would see in terms of the bank index itself. So the bank index, which is very low weighted in terms of the PSU banks, moved up a lot because the size of the move in the PSU banks was very, very large. But at the same time, you had private banks selling off, and therefore you didn't really get a breakout in the bank indices. So if you just take the phase from the August high to where we are today, the bank index has actually made lower tops while the Nifty has made higher tops, creating what we call an intermarket divergence. Now, will it attempt to break that out? So far, it has not been able to. Even after this event, prices simply touched the upper line of the range, tried to pierce beyond it, but have fallen right back and closed inside the trading range. And that continues to show you that the banking sector is weaker than the others, and is probably going to be leading the way down. And unlike what I would have thought is the mid cap indices would actually lead the way down, but they've continued to stretch higher and higher in what is a broadening range that starts all the way back from May of this year. So since May of this year, the mid cap indices entered a broadening range and have been volatile on both sides. They've sold off several percentage points, then rallied to a new high, then sold off, giving back most of those gains, and then again rallied to a new high. And while this expanding pattern appeared complete into the month of September, I think Bank Nifty only started forming similar expanding patterns from August onward, so many months after the mid-cap indices did. And Bank Nifty is still within that pattern, whereas the Nifty has marginally broken out, but a much broader index like, say, the 500, CNX 500 or the BSE 500 index is just near the upper line of this broadening range for the entire August to October period. And last month we also saw several of the sentiment indicators. So we saw things like the put call ratio, the OIPCR, hit its highest level in many years in August, and I would have thought that high was an extreme, but in October we ended at hitting an even higher reading. So now this month's reading at 1.42, and this is market wide. I'm not talking only the Nifty, which also has made a significantly high reading, a multi-year high reading. So you have this all-time record reading in the OIPCR, which we haven't really seen, and that essentially shows that a lot of puts were essentially written, okay, but simultaneously you haven't seen a jump in the volume of put calls. So this has been more writer confidence than buyers. So if you say that buyers were buying puts and getting stuck, that's not really been the case, because essentially there's not been a lot of volume. So when you look at volume PCR, you're essentially looking at sentiment. Was the sentiment negative? The answer is no, it wasn't, at least not in terms of the data. But when you have a high PCR, it shows a lot of confidence in the upside for the market, which is why a lot of selling of puts, which is really a bullish activity, takes place. If you were negative, you would be selling a lot of call options. So the bullish confidence was at a super high, which is why you had the highest net OI also in the difference between the total call put open interest in the market. And so similarly, there were a couple of sentiment measures that reached their extremes once again, like they did in August. Rather, I should say they did in July. So what typically happens is when you reach that extreme, because the derivative expiry, you continue to hold on to that high OI position, because that provides sort of a support from the writers. The sell-off actually comes in the next month, as we saw in August. Now, September was rare because there too you had a good amount of writing into the last week of September, but you sold off within that same month. So in a rare occasion, writers get caught off guard, but usually that's 10-20% of the time. I guess 80% of the time you see the other situation, which is what we've seen this month, that the high PCR essentially kept markets elevated into expiration. And I think the real risk, if there's any, from that extreme positive sentiment that has developed, is actually in this month. So we'll be watching how markets pan out. So far, they've still been edging higher, but typically after an extreme sentiment month, the next month appears due for some kind of a correction. So that's where we are. The news events have added to creating that positive sentiment. Amazing that these announcements came within expiration week, so they definitely were tuned to keeping things elevated for that week itself, and also caused this really wild move on both sides, because if you noticed, all the PSU banks being up, and you had all the private banks and NBFCs actually selling down simultaneously, which was, I think, something unusual. A lot of people would not have expected, because till a few days before that, I was being told that if you just want to predict what the bank Nifty is going to be doing, which a lot of people are interested in because of the weekly options, you just look at stocks like HDFC Bank, which has a very, very high weightage in terms of what the so 30% weightage causes the biggest moves. I mean, most of the move in Bank Nifty, but this time around, the big moves in the PSU banks ended up, contributing to the upside. But it might also have to do with one particular bank, that is ICICI Bank, moving up with that entire pack, because it was one of the weakest uh, banks, along with the PSUs, including Axis. So essentially, uh, what it led to is short covering across the board. So it would not just be PSU banks, but whichever banks were weak led to short covering, and you had a sell off in whichever was strong. And essentially, it would look visually to us as a lot of unwinding happening on both sides of the trades, as far as trading positions are concerned, is what would have driven a large part of the move that we saw this week. But now that expiration is done, most of those cuts have taken place, is where you'd start seeing again logical movement. Now, why would the government really force squeezes on both sides? I mean, to me, it doesn't make sense, because time and again this discussion has happened that when you have shorts, they also act as buyers at lower levels and provide support. When you squeeze it all out, then actually, if any selling pressure comes in, then you actually lack buying support that you would want these banks to really have. So that's just another way of looking at it. Every time there's this attack on, or a blame game between, well, the markets are down the short side. You saw it in 2008. Many markets actually start banning short sales in the hope that this doesn't work. And analysts always point out that you're actually doing away with buyer support, so any selling would actually make prices fall even more sharply. So that argument really goes off the table. So if these steps were essentially to squeeze positions, because while they are important in the direction of the broad reforms, in the short term, what they've essentially done is squeezed positions out of the market. So what should really you be watching out for in terms of risks to the market? I think the big one continues to be one that has spoken out for several months, and it's been a slow mover, but it's still an active event, and that is the falling bond market. And I'm talking of US bond market, which means rising interest rates. I've always maintained that India has one interest rate spike, and in fact, last year when the US bond market sold off, the only reason I think our market did not see a spike in rates was because we conducted what is called demonetization, that moved a lot of money into the Indian bond market, and subsequent to that, then bond buying continued with opening up of foreign money, with most of the limits of which were already hit. But now that you're getting the second round of sell-off in US bonds, and you're in the early stages of that, but if you're watching, then you're consistently seeing the 10-year and 30-year yields going higher, and if that trend continues, then I think it's a multi-month trend, at least last for the next 2 months, if not more, and that will cause US 10-year bond yields to spike up maybe to 2.6, 2.7, or maybe even 3%. And when that happens, I think Indian bond yields, which have also been slowly rising from, they're almost come close to 6.25. Now they're close to 6.8. They'll cross the 7% mark. Bond investors, who are essentially traders, in many cases, it's also a form of hot money, who essentially bet on not just yields, but the direction of yields, would start looking at, booking gains. So that would put pressure on the currency. And so my sense is rising US bond yields essentially is one of the major risks, which was also a driver of risk in 2013, when you had what is called the taper tantrum. And this time around, we really don't have a name for it, but the US is moving towards a quantitative tightening, while Europe is holding back, which essentially puts the dollar again in favor in terms of trend. It is rising and continues to rise along with rising rates, and that I think is the biggest headwind, I think, for our markets, and they may continue to ignore it for a while. In fact, US markets themselves may ignore it for a while, and I put out an insider video just showing how bond yields behaved in the along with stock markets in the past. They usually remain inverted up to a point, which means it's considered good for equities, because you consider that market saying that money is moving out of the bond market into the equity market, but when bond yields keep rising, there's always a trigger point at which it starts hurting, and then both of them move in tandem in that direction. And so that example showed that that lag can be quite a bit. And usually when you start the third wave down, or when you break the previous swing low, so that would be closer to around 2.5 to 2.6% on the 10-year. I think you're at 2.45, so another 5-10 basis points is after which I think people will start worrying about rising yields in the US. Till that point of time, it may be taken as a positive sign for equities, at least in the US. But for our own markets, we don't really need to correlate with the US market on a day-to-day basis, and especially when you're looking at market turns, and especially medium to longer term turns, most markets tend to have a lead lag which lasts for several weeks between each marketplace, and I would expect that in this case itself. So that's all in this update from me, and like I said, tomorrow we'll be having this Facebook Live session with on Sher Khan on their Facebook page. Is the first time we're trying to do this half an hour to 40-minute session, and if you have trading related questions, you can post them there or discuss them there, and I'll continue to post my daily updates every day as usual. So that's all. Thank you.